and further highlight the need for a national grid system, and a move towards electrifying our entire national energy network. Moving on from here, I want to revisit this slide that we looked at in the beginning of 2 weeks ago when we first started class, 4 classes ago. We looked at trade numbers, and we showed the U.S. top trading partners beginning in 2017. We pointed out that we started a trade war in 2018, and we looked at trade totals between 2017 and 2020. We didn't have a complete year for 2020. Now we do. What do we see here? We see that beginning with the base year of 2017, before the trade war kicked in, when we were at $5.2 trillion in trade, we ended 2020 nearly 30% below that at $3.769 trillion in total trade. As you can see, imports are down 20% from 2017, and exports here are down 35% from 2017. What was the big objective for the trade war? To somehow box out China, to displace China as America's leading trading partner, to end our so-called dependence on China. Let's take a look at a map here of a chart of trade exports to China over the course of the last 25 years. What do you see here? Exports to China have exploded. There have been peaks and valleys, but the long-term trend is clear that exports to China have significantly increased. We see a big dip here as a result of the COVID-driven recession, significant contraction here, but we've regained some ground as we move towards higher exports. What do you see here on the legend on the bottom? We show exports, imports to China, along with total trade to China and the rank of China as a trading partner to the US. In 2017, we did $636 billion of trade with China. They were our number 1 trading partner. 4 years later, while still engaged in a trade war, we're doing about 12% less trade overall. We're doing 12% less trade overall with China, about 14% fewer imports from China. We're exporting fewer goods to China, and China still remains our number 1 trading partner. Have the objectives of the trade war been achieved?
No.
No. The trade war objectives have not been achieved, and we haven't addressed, of course, all of the downstream effects on American farmers and American companies that use such things as steel and aluminum. We haven't even talked about the timber tariffs on timber. Who's one of the biggest suppliers of lumber to this country? It's Canada. Well, as a result of tariffs on lumber prices, well, out of Canada, lumber prices soared 105% over a period of a couple of years. And of course, what does that do to the building of homes? It makes them what?
More expensive.
It makes them more expensive. And who pays for that higher expense?
Consumer.
If the contractor doesn't absorb the cost, what does the contractor normally do? He or she is paying more for their lumber that they're importing from Canada because of this trade war imposed by the last administration. To whom are they going to pass on the cost?
The consumer.
The consumer, whether the consumer is the developer or the end user. So we looked at trade over the 4 years. We've looked at exports here. Now we see what? We look at GDP in the US versus GDP in China since 2016. What do we see here? I want to point out a couple of things. If we look here in the first quarter of 2020, what do we see? We see that GDP prior to that is roughly 2.5%. Yes? In the first quarter of 2020, we saw unemployment at 3.5% and inflation at just about 2.1%. And so the idea that we can't be at full employment or higher than full employment without soaring inflation is a theory that's been completely disproved. What else does this chart show you? It shows you that both the US and China took a severe hit as a result of the COVID pandemic here. What's the difference between the way the two countries responded? Well, what did China do? China was aggressively handling COVID. They had very significant material industrial support and targeted stimulus that prioritized industry in China. And what did that yield? That yielded economic success. And so as opposed to the US, which has not followed that same very focused path under the last administration, we saw that China's GDP growth contracted 4.9%, but pardon me, their growth expanded 4.9% following a 6.8% contraction here. Okay. So whereas the US lagged in its response to the COVID pandemic, where it has lagged, China has excelled. And therefore, we see the result in China's GDP growth. Does everybody understand that? Any questions here before I move on? Okay, we're gonna come back to China, but before we do, I want to look at the numbers from last week. This was the economic data that came out last week. In fact, since we're just getting underway, just lay out what we're going to go over today. I want to talk about some I want to talk some more about these indicators we haven't introduced. I'd like to talk about opportunity costs and comparative advantage. We're going to talk about some trade instruments, and we're going to talk about growth measures like GDP. It's an ambitious agenda this evening, and I'm hoping that we can get through it. But please, as we're running through the slides, ask me a question or bring up comments if you have anything you want to share with me. As a side note, last week the UK announced that its economy contracted by 10% in 2020, the worst year since 1709. So that's a couple of hundred years. That's pretty bad. One of the things that we're going to talk about in the coming weeks is what the impact has been of Brexit. Remember, of course, that under the European Union, what's the hallmark of the cornerstone of the European Union? The idea of frictionless trade, the movement of goods, services, and people without any friction between the countries, of all the members in the union, right? Well, now the UK is no longer part of the union. So that means what happens to frictionless trade? What happens to frictionless trade now that Brexit has been undertaken and the UK is no longer part of the EU?
This
Does not exist.
It doesn't exist, which means there's a lot of friction. There's a lot of friction, and we're going to talk about that in the coming weeks. So anyway, turning our attention back here to economic indicators, what do we see? We see that jobless claims came in higher than we expected. Oh, sorry. Jobless claims in higher than expected. Continuing jobless claims are slightly slower, but obviously much higher than they've been historically. Consumer sentiment is way down at 76.2, or a much lower reading than we've seen before. And obviously, what's the takeaway here? The takeaway is that the COVID crisis continues to weigh on the job market. It continues to weigh on consumer sentiment and remains a drag on the overall economy. Are there any questions here?
Yes. How do you measure it?
How do you measure consumer sentiment?
Yes. Based on what? Based on
It's a survey of 5,000 homes.
Okay.
It's a survey of 5,000 homes by the Bureau of Labor Statistics. Consumer sentiment and consumer confidence.
It looks into what are they doing with their money, or they
It
just
considers what is their consumer sentiment, tracks the views on consumers' ideas about the strength of the economy.
How is
So they
that?
just go
Consumer
to
confidence
5,000
considers the
homes,
consumers' views on the strength of the job market. Sorry?
So they go to 5,000 homes and ask them, what do you think about the economy?
It's a poll. It's a poll. It's
Okay.
exactly right. It's a poll.
Okay, thank you.
You're welcome. It's a monthly poll. That's exactly right.
Are they randomly selected, or they make sure
Yes,
ask
they're
them
randomly
about
selected.
randomly?
That's exactly right. So these are the data that came out today and tomorrow. That came out today and is coming out tomorrow. I want us to look at some of these. It's a good opportunity to introduce some of the other important economic indicators that we use as barometers for the strength of the US economy. So you see retail sales number came in much higher than expected at 5.3%. Industrial production was also much higher, 0.9%. Move down here, housing starts and building permits will be coming in over the course of the next couple of days. Let's take a look at some of these charts though. If you look here at retail sales, what do you see? You see that retail sales here in the first quarter of 2020 really got hammered. And so we saw some enthusiasm in the market today because what's happening here, we see a pop in consumer spending in the month of January. Yes?
Yes.
Okay, if we look at consumer spending though, excuse me, just a second. If we look at consumer spending, you see also that there's a big hit taken here a big hit in consumer spending in the first quarter of 2020. What do you see here? What's the other trend that we see here? We see that consumer spending, despite retail sales showing a pop in the last month, what's the trend here with consumer spending over the last couple of months? We see consumer spending trending downward. Yes?
Yes.
Right. So we see consumer spending trending downward, which ties into the news that we saw before, the data that we saw before about the job market, about the slowing job market. We see that the job growth has slowed, unemployment remains persistently high, and
Professor?
yeah.
Would you mind just returning to this? Yeah, that slide. I just want to take a picture of that. Thank you.
Okay. Okay, so
Can I ask a question?
of course you can. That's why we're here.
Okay, but consumer spending, from my knowledge, is that it always goes downwards after the holidays. So isn't that
That makes a lot of
accurate
sense.
figure?
Consumer spending, right. So what's weighing on consumer spending after the holidays here? Well, it's what's weighing on consumer spending here. It's after the holidays, but we can extrapolate that it's particularly weaker. It's weaker also because of the COVID crisis and because of the lack of job creation and overall negative sentiment in the market. Where we see enthusiasm in the market is in the where we see enthusiasm is in the capital markets, enthusiasm among manufacturers, home buildings, for the expectation of what's going to happen in the future, a nearly $2 trillion rescue package, and the expectation that along with it, the economy will continue to methodically roar back to life. If we look here at industrial production, another number that is coming in this week, we see what industrial production is another monthly indicator that shows industrial output. It's highly sensitive to interest rates and to consumer demand, as you would expect. What's happening here? We see that there was the largest contraction, nearly 10% on record here in the second quarter of 2020. So what's happening here is it's roaring back to life. As I point out to you, this was the reading in January. It's a 0.9% at 0.9%, an increase of 0.9%. That's the fourth straight monthly gain. So what's this all about? This all is about what I just said before. It's about expectations. The expectation that the consumer will return, the expectation that the government will stand ready to support the downturn in demand, that the Federal Reserve stands ready to pursue accommodative policy well into 2023, which means keeping interest rates low and priming the pump, continuing to buy bonds and other Treasury securities to keep long-term rates low. But again, this is really what you're seeing is an illustration of expectations.
Professor, would one of the expectations be to keep printing more money and giving people?
Yes, the expectation is that the Fed is going to keep its bond buying program in place. It has said that it has no intention of releasing the gas, so to speak, until 2023. There are no rush to raise interest rates. In fact, they've provided tremendous guidance to the markets in terms of interest rate guidance, that their expectation is no longer to target 2%, that they will not raise interest rates preemptively, that they will wait at least until inflation is at 2%, which is still considered very safe. We've struggled to get to 2%. So the answer to your question is yes. The Fed has made clear through market guidance that it intends to stay vigilant in terms of its accommodative posture, accommodating the markets, accommodating demand over the course of the next number of years. If we move forward, what have we got here? This is vehicle sales, another important barometer of the health of an economy. And what do you see? You see that the record was just over 18 million vehicles per month in sales. Vehicle sales obviously are very sensitive to any type of shock, any type of negative event. And of course, the COVID recession, people stopped traveling, people stopped buying cars. We've seen a huge hit in monthly sales of cars. But what's happening? Car sales are rebounding. Why are car sales rebounding?
Low rates.
Low rates, absolutely. Low rates are there, but the low rates already existed. What's the other thing? It's the market sentiment, I think. I think
People
it's
are
the
expecting
enthusiasm that
everything.
people believe that they will start to travel. There will be an end point, and there is an opportunity to seize at the moment, perhaps between the combination of short-term of low rates and the belief, the strong belief based on reasonable evidence that we're going to have a solution to this pandemic in relatively short order. The president has said that everyone that wants a vaccine will have them by July. I, for one, believe that that's the truth. Dr. Fauci says that by early fall, we should be moving towards a more normal existence. And so people are thinking, well, you know what, I might go out now and buy that car I've been thinking about, because once things start to get better, inflation may be around the corner, interest rates are going to rise, I should lock in a price now and buy a car. That's what I think is the mentality right now driving car purchases.
Yes, sir.
Professor,
Yes, sir.
Sure, go ahead, shoot, go ahead, everybody.
Isn't it before any crisis that there is always like inflation is high and there is a lot of consuming expectation. There is a lot of things that are looking good in the next 2 or 4 years. Wouldn't we consider that that would be not a clear indicator, but an indicator that maybe we're coming to close to a crisis?
Not at all. If you think that the crisis you're referring to is an inflationary crisis, we saw that in the aftermath of the 2008-2010 Great Recession, that despite extraordinary efforts by the federal government and the Federal Reserve to stimulate and support the economy through aggressive monetary action and stimulative fiscal policy action, we saw and unemployment that went from 11% to 3.5%. We saw no inflation. So the old idea that it's the Phillips curve. The old idea that lower unemployment translated to higher inflation is no longer the case, and we haven't seen that. And so when the Fed announced just a month or so ago that they would remain they expect their posture to remain in place into 2023. That's their accommodative posture. That was a very significant statement to make. In other words, the evidence is so clear to them that the Phillips curve no longer holds, that we can approach full employment, that it will be non-accelerating, as we saw the other day with NAIRU, the non-accelerating inflation rate of unemployment, that a stable rate of inflation will be tied to a stable rate of unemployment, and that we shouldn't expect to see any type of inflation pressure. To the extent that consumers now believe that the Fed will remain vigilant, the Fed will continue to print money, will continue to buy bonds and keep interest rates low. To the extent that there's an expectation that interest rates may rise, well, that's cost push inflation, and that may participate in some of the thinking that goes into what we see as being a big spike in vehicle purchases over the course of the last couple of months. If you look at here,
Professor?
Yeah.
Do you think that the work from home initiative will have a negative impact of the vehicle sales in the United States for the long term, or it's going to be?
That's a great question. That's a great question. The work from home trend is not going to end. The work from home trend is not going to end. We know that it's going to have a downstream effect on a variety of industries, not the least of which is the commercial real estate industry here in New York. In terms of how will the work from home trend affect vehicle sales in the future, that's a very good question. And I'm going to have to think about that. My first thought is to say it will affect vehicle sales negatively. Yeah. We have 75, 80 million people that commute to work. If they're no longer commuting to work, well, that's got to affect vehicle sales. So it's a longer answer to a short question, but my shorthand answer is I think that it definitely will affect vehicle sales. To what extent remains unclear. Okay.
Just to piggyback on some of that, I know that analysts were also saying that in the shorter term, a trend was that consumers were purchasing vehicles to stay away from public transportation as well.
Absolutely. Absolutely. Very good point. Very good point. Consumers buying cars to stay away from transportation. We know here in New York, the ridership on the subways is down tremendously. The ridership on the Long Island Railroad, a major conduit into the city for millions of workers who are not coming into the city or coming into the city by car, is down enormously, which poses another problem, another downstream effect on the city of New York, which faces enormous historic budget shortfalls because their riderships are down, both on the subways and on the railroads. So let's move on from there. We look at construction spending, which is another important indicator coming up in the next week. And what do we see? Again, we see that a huge hit here on construction spending during the start of the trade war, and then another huge hit here during the beginning phases of the COVID pandemic. The point I make here is that the last administration imposed 24% tariffs on Canadian lumber. That led to an increase of 105% over 3 years to the price of lumber, raw lumber coming in from Canada. That is a significant negative effect on the cost profile of builders. And obviously, there was a negative impact, and those prices get pushed through to the end users, either the developers or to the home buyers, and is yet another example of a trade. It's another example of a punitive action taken by the last administration that served no purpose, and the only people that it hurt were the people here in America. Okay, so hold on a second. I'm going to step away for a moment.
Hey guys, do we have a WhatsApp group?
We do. I'll share it.
Okay, I'm back. Okay, so let's look here. The items that are coming out, we have housing starts and building permits that are coming out tomorrow. So let's look here. Housing starts are just going to, what do they tell us? That housing, homes, apartments, and townhouses that have started construction in the month, as opposed to building permits, which is a forward-looking indicator that indicates future construction. And as you can see, in both cases, what's your conclusion? The conclusion is that since the depths of the Great Recession, the U.S. housing market in fits and starts has slowly recovered. Yes? Has slowly moved towards recovery. Except in both cases, you see that the U.S. housing markets have taken a big hit here during the COVID pandemic. Okay, so yeah.
Will you connect these points that the housing starts rise to Home Depot and Lowe's stocks? Because
does the increase in building permits and housing starts correlate to the
Home Depot and Lowe's?
I would think so. I would think so. I don't trade those stocks, but I would think so. I think that the better the housing sector does, that the corporations that supply the housing sector, that are benchmark companies for the housing sector, like Home Depot, are going to do well. Yes, that would be my back of the envelope conclusion. Yes, am I right?
I think so. I mean, I just thought about it.
Okay. So last week we ended up looking at global trade risks. This is the section. This is we got through what I want to talk to you about, indicators. I wanted to take a look here at different trade risks. Very straightforward. We talk about foreign exchange risk. Of course, we're talking about the sensitivity of companies' receivables and payables to the foreign exchange. We talk about transaction and translation risk. It's the same thing. It's a sensitivity of a company's contractual transactions to foreign exchange changes, and the sensitivity of consolidated financial statements to changes in foreign exchange. Let's say you have a car dealer in Thailand. No, let's not do that. Let's say you have a car dealer in
Mexico.
Mexico.
That was a good one. No, Mexico wouldn't. No.
Germany.
How far do you want to go?
I'm thinking that our car dealer is going to be in South America.
Ecuador.
Brazil. She's a Brazilian car dealer, and she's a Brazilian car dealer. And so her base currency is the Brazilian real. And she gets cars, she's a Toyota car dealer. And so Toyota ships, the way that the car industry works is a hub and spoke system. The hub is the company and the spokes are all the dealers around the world. And so what they do is they provide zero cost financing by providing the cars before they're sold. So they know that it should take, let's say, 9 months to sell a particular type of Toyota. So in this case, they provide zero cost financing because they're not going to ask the dealer to pay for the cars up front. They're going to give her time to pay the balance. However, they're not going to assume the foreign exchange risk. They want to be paid in yen. So she's got enormous foreign exchange risk. She's in the real market. She owes, let's say it's $3 million worth of cars that get shipped to her. She owes that in 9 months' time. The car manufacturer provides very favorable financing terms, but they charge zero cost financing. That allows her to pay for the heat, electricity, and salaries of the people that work for her in her showroom. She's still got tremendous exchange risk. If the real weakens over the course of the 9 months, that increases the cost of her yen payable. Everybody should understand that, okay? And so she's got tremendous transaction risk there, okay? And that's just a small example. You could use that anywhere. If you're a US-based, I know a Queens-based manufacturer here in Elmhurst who sources material in Asia, whether it's in yen or yuan or other Asian currencies, in the Thai baht, they do business in the Thai baht. If those currencies rise against them, then of course, that puts the squeeze on them. And so that's an example of transaction risk. And translation risk is a very, very simple, just your end of the year statements. If we move along, look at economic risk, liquidity risk, and business cycle risk. Well, again, the sensitivity of your cash flows to foreign exchange changes. Liquidity risk, I'm sure are all familiar with. It means that there's a lack of a secondary market. Your assets cannot be easily sold, okay? Business cycle risk is, again, at what point in the cycle is your company looking to do business? And how well does your company do in each one of these periods? Some companies do very well all year long. Other are always in demand, food companies, for example. Other companies do better at other parts of the year. So the business cycles we consider are growth, peak, recession, and recovery. Other global trade risks we think about are management risk and agency risk. This is just about personnel. You can have great ideas and lots of money to implement those ideas, but if you don't have the right people to do it, then of course you have a big problem. So that's management and agency risk. Domestic political and regulatory risk is always a concern for multinationals looking to do business or trade around the world, and something that we're going to talk about in greater detail as we look at such things as the importance of good governance and effective legislation domestically when we move on in the next couple of weeks. Next, in terms of global trade risks, we talk about force majeure, which are things like hurricane and drought, and what we're seeing now in Texas and other parts of the Great Southwest in terms of unexpected winter storms. Geopolitical risk, whether it's the Iranians closing the Straits of Hormuz, which is going to roil the global oil markets, or it's growing income or healthcare inequality around the world, trade wars, which we've talked about, or COVID lockdowns. All of these pose geopolitical risks that have consequences on the capital markets, and we've, of course, talked about some of them. Then, of course, there's funding and interest rate risk, which is always critical. Remember, interest rates is the cost of money and the return on money, and being able to access capital is an omnipresent concern along with foreign exchange risk. With that said, I'd like to turn our attention to a problem here. If everyone has a calculator, let's go through this problem. Now, my top is blocked here. Can someone read it to me? A multinational has total assets of what? Is it 25 million and debt of 8 million?
Yes.
Yes.
Okay, good. So the board tax cost of debt is 11.7%.
Yes.
Their cost of equity financing is 14.5%, and their tax rate, thanks to President Trump, is 21%. The question I have is, what is the weighted average cost of capital? Because when you're operating around the world, or even operating domestically, but for our purposes, we're looking at multinationals and international trade, what is your cost of capital? Because you're not going to deploy capital and deploy assets abroad if you don't know what your cost of capital is, because you need to earn more than that in order to justify deploying capital around the world. So the question here is, what is the weighted average cost of capital and the hurdle rate with a risk premium of 10%? Can anyone tell me what the hurdle rate is?
It's just 10%.
The hurdle rate is the expected rate of return. If I have a weighted average cost of capital of 10%, my hurdle rate is 10%, that means, and my risk premium is 10%, that means I have a hurdle rate of 20%. I need to earn 20% to cover my WACC and cover my risk premium. Okay?
Can you please repeat about the calculation?
Well, we're going to go through the calculation now. Do you understand hurdle rate and WACC?
No, really. Could you go over?
Okay. So weighted average cost of capital, there's a formula. We're going to go through that. And the hurdle rate is the rate of return, the required rate of return of a company. So a company is saying, what is my capital costs, my debt and equity capital costs, my blended costs? On top of that, in order to move my money overseas, outside of my domestic market, I require a risk premium, a return of 10%. So I need to earn, if it's 10 and 10, a total of 20% in order to justify the deployment of capital. Excuse me.
Professor, is there another term for hurdle rate that might be synonymous to that?
Return of investment, required return of
Gotcha.
investment, like ROI. So let's look at this is the formula for WACC. This is a formula that you'll need to know for the exam, and one we'll come back to. Just as a side note, I know I'm sort of throwing things in here, but we're all on the same page. We're gonna finish up with capital markets and chapter 1 next week. So at the end of next week's session, Wednesday, you'll be assigned chapter 1, and from there we'll move on to 2, 3, and 4 before the midterm at the end of March. But it'll be tonight and the next 2 sessions that will take us through the final material on chapter 1 and all the capital markets material, which includes this. So this is the formula for the weighted average cost of capital. So you have your debt over your debt plus equity plus the cost of debt, 1 minus the tax rate, over equity over debt plus equity times the cost of equity. And now all that it is a plug-in. Yep.
Will we have to denote it as such, or could we do it as cost of equity times percentage of equity plus cost of debt times percentage of debt, et cetera, et cetera?
In other words, in terms of calculating the answer?
Well, do we have to denote it as
Calculate
such
the answer
like this?
using a different.
No. No. In essence,
I'm
it's
going
the
to
same
ask you
formula.
questions. I'm going to ask you questions on. I'm sorry. If you as long as you get the right answer, this is the formula for WACC. If you have another way of doing it, good for you. But this is the standard formula for WACC. And I'm going to ask you a question that says, much like this, these are the data. Tell me what the weighted average cost of capital is. So here we see, why is it the tax shield? 1 minus T means you can deduct the interest on the debt. So that becomes a tax shield here in the United States. So if we look here, we're just plugging in. It's 8 over 25, which is the debt over the equity. Now, how do we get the equity over the debt? Well, it's the debt plus the equity. What is the company's assets? It's its debt plus its equity. Okay, so we have 8, and then we have 25 minus 8 gives us 18. No, it's wrong. It should be 17. That's wrong. That's wrong. That should be 17. Okay, we're going to fix that. I rejiggered some of the numbers, so that's going to be a little bit less. Okay, it should be 7. I'm sorry?
So you said is 8 plus 17 or plus 14?
Hold on a second, folks.
Thank you.
Let's just look at it together, okay? In real time, let's just look at it together, okay?
Mm-hmm.
Just bear with me for a second. Okay. Oh, no. Oh, huh.
Are we assuming there's no preferred?
Okay, sorry about that, folks. So let's look at this together now. I apologize for that. That's absolutely my fault. I missed that when I was going over it, and I changed some of the. I was working on this earlier today. So getting back to our discussion. What's going on? Okay, so here we are. Okay, so we just plug in the numbers. We said 25 minus 8 gives us 17. We plug in the numbers. We come up with a weighted average cost of capital about 13%, right? And so if the hurdle rate plus the WACC gives us 23%. Okay, that means that we need to have a return offered to us abroad of 23% in order to cover our WACC plus our risk premium. And then the questions I had for you: why is debt cheaper than equity? And there are the reasons. Why? Because the debt is secured by the assets of the company. There is an obligation to pay. And what happens in bankruptcy? In bankruptcy, debt gets first priority, but your equity gets wiped out. Okay? Okay. Are there any questions here?
Yeah, Professor. Sorry, could you go back to the formula? I know the formula in theory, but I've never actually applied it. Where's your preferred? Because in the formula, there's the cost of preferred plus times your percentage of preferred.
There's no cost of preferred. There's the debt plus equity. There's the cost of the debt, the cost of the equity, and the one minus the tax, which is your tax shield, which you deduct your interest payments.
So
Okay?
in this example, we're assuming no preferred.
In this example, there is no preferred. In this
Okay.
Right. In this example, the company has straight equity financing at 14.5%, and before their debt costs are 11.70. And your challenge is based upon that very simple those very simple figures, and $25 million in assets and $8 million in debt. What is the weighted average cost of capital given the formula here? We plug on all the numbers. We come up with a weighted average cost of capital of 13%. If your premium is, you need 10% premium on that, you need to get a 23% return on wherever you're putting capital abroad. If that's what, for example, your board of directors, whatever management team has established as a benchmark return.
Okay, and I'm sorry, go ahead.
I wanted to just ask about the before tax cost of debt and the cost of equity. Do we need to know how to get those numbers, or are you?
No, because I'm going to give you all those numbers.
Okay, thank you.
What I want you to understand here is what the concept of weighted average cost of capital. What is my cost of capital? What is it costing me to run my business? I have an equity cost and I have a debt cost. What does it cost me? That's the first thing. I want you to understand the hurdle rate. Beyond that, though, of course, I'm going to give you all of the raw data. Okay?
Perfect. I was just asking because finance,
again,
we have to figure it out ourselves.
That's fine. Of course, it's a perfectly reasonable question. But again, it's an important concept to understand as global managers. What is weighted average cost of capital? What is the cost of a company to operate its business? Okay. So now, when we talk about spending shocks, we've talked about before, we said that if there's a disruption in the oil markets, that could lead to a spike in prices. We saw that as a result of meetings recently between the OPEC and OPEC plus countries, and Saudi Arabia agreeing to a million barrel oil a day cut in production. We saw a spike in oil prices. That acts as a negative spending shock that reaches its way all the way to the gas tanks and increases the cost of American consumers that are driving their cars, not to mention drivers of cars all over the world. So it's a change in spending in one sector that sets off a chain reaction in multiple sectors. So you see positive and negative cycles of spending. The change in GDP as a result of the negative or positive spending shock is greater than the initial change in spending because of the multiplier effect, which you may not have heard, you may have heard of before, because there are multiple cycles in a spending shock. Okay? And when we talk about spending shocks, we talk about what causes a recession and what causes an expansion. Well, recessions are triggered by a spike in oil prices, a fall in government spending, spike in interest rates, drop in consumer spending, a drop in industrial spending, a spike in inflation, a downturn in consumer sentiment or an uptick in unemployment as consumers become less likely to spend. At the same time, we see what are expansions triggered by. Expansions are triggered by the exact opposite of what causes those recessions. An increase in government spending, a decrease in oil prices, so on and so forth. Are there any questions about any of this data here? What I'm interested that you understand is what is a spending shock? What is a negative spending shock? What is a positive spending shock? If the government is going to pass a $1.9 trillion rescue package, that's going to have a positive spending shock effect on the economy. If the government passes an increase in the federal minimum wage after 11 years, that's going to have a positive spending shock, both locally, regionally, and nationally. Okay? If there is some sort of unexpected curveball coming with COVID or any other geopolitical event that we can't foresee yet, that's going to take a bite out of consumer spending or business spending, well, then, of course, that's going to have a negative effect on overall GDP. Any questions here?
Yeah, Professor, sorry. Could you go back to the previous slide?
Here?
Yeah, thank you. Got it.
You're going to have this all in the next, when class is over, I'll post it within an hour or so. Yep.
Are we going to use the hurdle rate in this example?
This is the hurdle rate. The hurdle rate here is 23% because you came up with a weighted average cost of capital of 13%, right? Your risk premium is 10%. That means your hurdle rate is 23%. In other words, the company needs to earn more than at least 23% abroad in order to deploy capital.
Also, you add the result that you get from WACC.
That's exactly right.
Got it. Thank you.
That's right. Okay. So now we talk about consumption spending and the multiplier effect, which we just looked at here, the idea of the multiplier effect and spending shock. So Keynes came up with a very interesting concept, which was the consumption function, which is what you're looking at right now, which plots consumption versus income. And what you see is the near linear relationship between consumption and income indicated there on the graph, okay? So we see the y-intercept. The y-intercept indicates where income equals 0. So it's the influence on consumption by everything but income. So it's the wealth effect. So if some of you have some stock and the price goes up, it's not a change in your income, it's a change in your wealth. And your sense of your wealth, the sense of how much wealth you have is what will get you to buy a new car, buy a new house, buy a new something, right? Okay. So it's everything that affects the wealth effect is everything to do with your consumption having no impact of income. It's influence on consumption by everything but income. Excuse me for tripping there over my words, right? Influence on consumption by everything but income. That's your y-intercept. So your marginal propensity to consume has got to be between 0 and 1. Okay, so that is the slope of this line, the slope of the consumption function. So it's the change in spending over the change in income, which your marginal propensity to consume is less than 1 and greater than 0. So to determine the expenditure multiplier, all we do is we set up that simple formula here, 1 over 1 minus the marginal propensity to consume is going to quantify the GDP effect of any type of spending changes. Now we know that disposable income is the single most important factor influencing consumer spending. Okay, so this is our first real introduction of John Maynard Keynes, the brilliant English economist who was so helpful to Franklin Roosevelt during the 1930s, addressed the major catastrophe of the Great Depression and helping him to craft the New Deal that set America on an entirely different course. And so one of his signature concepts was the idea of the consumption function. So let's extrapolate that a little bit and look at the gas market. So US consumers, we know, consume about 140 billion gallons of gas per year, okay? We know that a $10 per barrel increase in price of crude oil correlates to a 25%, 25 cent per gallon increase at the pump. So it's a 40 multiple there. So a $10 a barrel increase is going to leave consumers with $35 billion less to spend per year. How is that? Because they're spending 25 cents more per gallon times 140 billion gallons gives you $35 billion. Okay, so any change in oil prices acts like a spending shock for the entire economy. Again, a change in spending sets off the chain reaction until the new GDP is achieved, which is greater than the initial spending, as we just showed, due to the multiplier effect. Okay, so according to the Energy Information Agency, in 2019, 123 million US households spent about $200 more on gas. And so the question is what was the spending shock effect of higher gas prices on consumer spending in 2019? It's very simple. Well, first I have to tell you what the marginal propensity to consume is. For some people, it's higher than 1, in fact. You can have a marginal propensity to consume higher than 1. How is that? Well, I earn $50,000 a year, but I spend 75, right?
Credit,
But
right?
for most people, it's what? What's that?
Is it through credit, right?
Exactly, right. You spend more than you earn, okay? And of every dollar I earn, I spend more than the dollar that I earn. Some people, of course, live that way. It's dangerous living, okay? But on average, the MPC here in the States is about 80%. So out of every dollar I earn, I spend about 80 cents, okay? So the expenditure multiplier, all we do is we plug in 1 over 1 minus marginal propensity to consume gives us 1 over 0.2 equals 5. So the expected change in spending is 123 million US households spending $200 more on gas, and 80% marginal propensity to consume multiplied by 5 gives us $98 billion. So that means the expected change in spending is an additional $98 billion spent on gas in 2019. This is an example of how we can use Keynes's theory about consumption, about the consumption function, the marginal propensity to consume, to solve problems here today. Okay?
Yes. Are you going to post a formula sheet?
I'm not going to post it. I mean, sure, yes. I mean, as we go through, I'm giving you all the slides. When it comes time before exams, I'll give you summary material, review material that will include all the formulas. There are not going to be so many formulas, a few. If we were, my expectation is that you're not going to have, it's not an open book exam, and that you're expected not to have the formulas in front of you. There are just a few of them. That's my expectation. I don't have much control over that. Certainly in the classroom, you wouldn't have a formula sheet. But I do provide you with ample material to study with. So the answer to your question is yes, I will provide you with that to study with. Which graph is that? Okay, what's the disagreement? The y-intercept is the autonomous consumption. The y-intercept is autonomous consumption. It's consumption having nothing to do with your income. Your income is 0 at the y-intercept. I'm going to read through the notes, and I'll come back to that. If someone doesn't want to bring it up now, I'll come back to it again on Monday. But the answer is that the y-intercept is where income equals 0. Just look at the map. Let's move on then. So I want to talk about conventional growth measures. The first one, obviously, is the GDP. We know that the GDP fluctuates around a positive upward trend over the long period of time. And of course, what Keynes identified for us was that there are short-term disruptions to longer-term trends, short-term boom and bust cycles, those expansions and contractions that we talked about, those business cycles. This is what GDP looks like over time. Okay, so how do we measure gross domestic product? Well, there are several components. It's consumption plus planned investment spending plus government spending plus net exports plus change in stock. Now, just to shorthand something, if consumers aren't spending, there's no planned investment spending, and exports have ground to a halt, who has to spend in a downturn? Who has to spend?
Government.
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 Government. So planned investment spending is PP&E and CapEx plus new homes. Can anyone tell us what PP&E is?
Property, plant, and equipment.
That is great. Yep, PP&E, plant, property, and equipment. Fantastic. So total spending, if we rearrange the terms, gives us total spending is consumption plus planned investment spending plus government spending plus net exports gives us GDP equals total spending plus the change in stock. Okay? So if your total spending here is less than your GDP, what we're saying is that you're producing more than you're selling, and that production is expected to fall as your inventory increases. This is considered an unplanned inventory increase. At the same time, if your total spending is greater than your GDP, what's considered is that you've run out of stock and your production is expected to increase. That's considered a planned inventory increase. What are the weaknesses of GDP? Stock, your inventory, your inventory, just your inventory, not equity, it's your inventory. Good question. So what are the weaknesses? Well, unreported activity like non-market production, black market and shadow economy, drugs, guns, people, all the bad things that we hear about in the news, that's black market, shadow economy. What would be non-market production? Non-market production is if I go to my brother-in-law's house and I help him paint the house, he doesn't pay me for it. That's non-market production, okay? So that's GDP, very straightforward. Now we talk about balance of payments, another measure of growth that we rely upon as we look at and examine governments around the world, countries around the world as potential places to do business. So it's your exports minus your imports, plus your capital inflows minus your capital outflows, plus your foreign exchange balances. If the government wants to support the US dollar using its foreign exchange balances, what's going to happen to its foreign exchange balances? Is it going to increase or decrease?
Decrease.
It's going to increase. If you want to support the US dollar, right, using your foreign exchange balances, what does that mean? Are you going to be buying foreign exchange or selling foreign exchange?
Buying them.
Well, if you want to support the dollar, you want to buy the dollar, right? So you're going to use your euros to buy dollars. That supports the dollar.
Is balance of payments is same as GNP?
Gross national product? No, it's not.
No.
It's not. Okay. So if the government wants to support the domestic currency using its foreign exchange balances are going to decrease because it's using its foreign exchange balances to buy its own currency. Okay. So exports minus imports, that's your current account. Capital inflows minus capital outflows, that's your capital account. So,
Professor, if the government wants to support the US dollar, shouldn't the government invest more or buy more dollar? What would they buy?
Yes, the government can buy more dollars by selling its euros for dollars. I'm going to buy dollars with my euros. I'm going to dump euros for dollars. That's going to strengthen the dollar and weaken the euro.
But Professor, once you already change your FXB, you already have an impact on your export and import. So
we're talking about different things. I'm not talking about FXBs with relation to exports and imports. I'm talking about another concept. In other words, the idea of foreign exchange balances that the government has, that the Fed can use in order to support or weaken the US currency. And so this is just simply an example. I'm looking at one of the components of the balance of payments and using that as an example or an illustration for Fed supporting or trying to weaken the US dollar. So as opposed to the GDP, which is the value of all goods and services produced but not sold, the balance of payments is an income statement that measures all economic activity. Remember, GDP is the value of all goods and services produced but not sold. The balance of payments is an income statement that measures all economic activities. So we say you have the current account, exports minus imports, your capital account, all the money that leaves the country, as opposed to all the foreign direct investment that comes into the country. And then finally, your foreign exchange balances. We know that a country has a trade surplus if its exports are greater than its imports, and has a deficit if its imports are greater than its exports. We know that positive net sales abroad contribute to the current account surplus, and like the US, which has negative sales abroad, which contribute to a current account deficit. And we've talked about some of the reasons why the US is able to maintain its deficits, its current account deficit, its trade deficit with impunity, as opposed to other nations whose currencies are punished. The reason being that the US is a reserve currency and has a special place in the global currency system. Okay, are there any questions here?
Professor?
Yeah.
Yes, can you explain again what CI and CO mean?
Capital inflows, money coming into the country, minus capital outflows, money going out of the country. So in any given year, we have money coming into the country from foreign sources, capital inflows, and then we have capital outflows. What's the net of that? Is more money coming in than going out? Just like, are there more imports coming in than exports going out? This is what the current account and the capital account show us. Okay?
Thank you.
You're welcome.
America, Professor, for the capital account in America, is that usually like always a surplus? As in like more money coming in than going out?
Not at all. We deploy an enormous amount of capital around the world. No, on any given year, no. In some years, yes, we've had, in some years we have a capital account, surplus because we have more money pouring into the country. But no, it's not a given that we always have more money coming in than we have going out. But no, we have an enormous amount of capital coming into the country. It's one of the reasons why the Fed pursues sterilization in order to offset the inflationary effects of all that inbound capital that's looking for the safety of our treasury markets. Yeah, there was a question.
What do they deploy money on abroad?
I'm sorry?
You said that they deploy a lot of money abroad.
No, I didn't say that the Fed does. I said that the country does. Foreign direct investment outside the country. Money that leaves the country. This isn't about the government. This is about the amount of money that's leaving the country. Money that comes into the country, money that leaves the country. So you have inbound capital coming to us from China into our treasury markets. That drives down interest rates, makes it easier for people to borrow and spend, but it also can lead to inflationary pressure, which triggers sterilization on the part of the Fed to try to neutralize what could be inflationary effects of inbound capital, of foreign direct investment here in the United States.
When you say money that leaves the country, do you mean like as us consumers buying from, what is it called? Producers that are in other countries?
That's exactly right. That's exactly right. Your company is going to move $10 million overseas to develop a, well, your company is going to move $10 million overseas to establish a subsidiary. That's an example of capital leaving the country.
Thank you.
You're welcome. Sure. Thank you. Good question.
Professor,
yeah,
I had a question. Is it possible for you in the next slide coming up to actually let us know what the abbreviations mean? Because let's say 1 week from now, I'm going back to the PowerPoint slide and I forget what the abbreviation means.
Well, like here, for example, for example, what abbreviations don't you know?
For right now, it's pretty self-explanatory because of short-term memory.
Well,
I can remember.
I'm going to post the slides for you later. One of the reasons that you come to class is to take notes.
Okay.
You're a finance student. You should understand that X and IM is exports and imports, capital inflows, outflows. I'm teaching that to you. So I'm asking you to take notes, and I'm going to post the slides later. Beyond that, as I'm going through it with you, what did you want me to do? Yeah.
No, it's okay. No problem. I think you understand it. No problem.
If there's a lack of clarity, if there's ever a lack of clarity, you don't understand, you ask me during class, after class, but I try to be as comprehensive in the slides as I am in my diligence following up with all of you with questions that I get. So, CapEx is capital expenditures by companies looking to invest, companies investing. Capital expenditures, that's all it is, capital expenditures.
Are your slides made directly from the textbook? Then if
No,
we-
I make all the slides myself in the capital markets material. No, I make all the slides myself. And the capital markets material I'm giving you, and no. So moving along, we've talked about gross domestic product. We talked about gross domestic product, the balance of payments. Now I want to talk about the Human Development Index, another common measure. It's a measure of human development. It was developed by the UN in 2010. It's based on life expectancy, knowledge, education, and income. It's a critical measure. It's a critical measure that is used throughout the world for development policies and investment policies by governments and institutions, private companies. It has three dimensions. It has a life expectancy index, which measures population health and longevity. It has a knowledge and education index, which measures literacy and access to education. And finally, it has an income index, which measures gross national income per capita, or GNI. That is the Human Development Index. This shows you from the United Nations human development split into three categories: high human development, medium human development, and low human development. Okay? And there are some highlights here from that coming out of the United Nations, which is the source of the information. Okay? So Human Development Index is a very critical, often used barometer of human living standards, of living standards. If we look at the Gini Index, just finally to wrap things up this evening, which is a measure of income inequality. It's a standard measure of income inequality developed in the beginning of the last century by an Italian statistician, economist, sociologist named Corrado Genie. It's called the Genie Index, or the Gini ratio, or the Gini coefficient. If you look up here on the upper left-hand corner, I've given you a legend. It shows that a Gini Index less than 2 gives you perfect income inequality, then from 2 to 3, relative equality, 3 to 4, adequate. Then you see a big income gap, and then a severe income gap. Anything over 40 is considered to be a warning sign. Now, if you look here, the US Gini Index, its most recent measure was 48.5, which shows increasing income inequality in the United States. A Gini Index of 0 is going to give you the most equal society, where every person receives the same income. As you would expect, there are quite a few Western European countries that are among the most equal societies, at least based upon the Gini Index. A Gini Index of 1 is the most unequal society, where one person receives 100% of all the income. Okay, so the low is Slovenia with a Gini Index of 24.2, and South Africa has a Gini Index of, I'm saying it's 0.63, but it said we pronounce it 63. Okay, so South Africa has the highest income inequality measure. And each of these measures, the Gini Index, the GDP, the balance of payments, and the human development, are all living standard indexes that affect development and investment policies worldwide. And that is what I wanted to share with you this evening, these 4 measures. Okay? Okay, we're not going to get to that. Well, we have 5 minutes left, so let's get through that. Are there any questions here about the Gini Index? Oh, okay.
Are they 4 index indicating the inequality of the inequality of
the nation? It indicates the inequality of the nation. So the U.S. has got the worst Gini Index that it's had since the Gilded Age back in the 1920s. It's income inequality that is this extreme is not sustainable. We know that. We've talked about that. We've talked about some of the issues about income inequality here in the country. Some of the things that are areas of concern, like low-wage workers, federal minimum wage. We'll talk about others as we move along throughout the semester. Yep. No. No.
Professor?
No. Yeah.
Do you think there is any correlation between the Gini Index and corporate tax rate? Because when corporate tax rates are low, you have more rich people in the country, which will raise the Gini Index.
Lower capital gains rates, and lower taxes leads to a widening income inequality, widening income gap. We know that. So yes, the answer is yes. That's a good comment. The answer is yes. Human Development Index and the balance of payments. Balance of payments has two components: current account, the capital account, plus foreign exchange balances. And the Human Development Index has the three components that we talked about. And I think that's where we're going to stop. Folks, I want to thank you very much. I'm going to stop sharing that right now. I want to thank everybody very much. I'm going to post all these slides for you in the next hours. I make sure that they're all just so. And there's no homework again this weekend. Like I said, you should have finished chapter